I think that the Fed is not going to do anything meaningful next week. The rates have been low for a very long time and will stay that way for some time. But the most important point to me is that the rates are not monetary policy. Monetary policy is bank reserves. It's the size of the Fed's balance sheet. And the Fed's balance sheet has $2.5 trillion going on $3 trillion of excess reserves. Those excess reserves are being turned into loans and deposits and are starting to lift prices and wages and costs in the U.S. So as long as the excess reserves are in place, I want to be fully invested in the stock market.
Okay, I think we should probably bring Daryl in here and take a look at the chart of the stock market. If you could get the S&P 500 up in front of you. I mean, we've seen numerous records coming through on the S&P 500, and in fact, lately we've also had records on the Dow. You must have been doing a lot of analysis on this, because yesterday we had a guest on the show saying, hey, you know what? Tear the charts up.
It's time to tear up the charts.
Yeah.
This is a fellow who's used charts in all of his investment career.
No, I would say no, Daryl. I would say no.
That's exactly right. So that means he missed the run from 2012, 13 into 14.
So listen, basically what we're trying to figure out is, this market keeps on grinding higher, edging higher, setting record after record after record.
So why are you terrified?
Very thin volume.
Why are you terrified?
No meat, nothing in the sandwich, nothing between the bread. Right? And correct me if I'm wrong, technical indicators, is this market overbought or not? It is, right?
No.
It's not overbought?
It's not. Because the key factor, you've got a long, well-established uptrend through here in this trading channel. Every overbought, oversold indicator will signal overbought because this trend has been in place for so long. They're absolutely useless in a strong trending environment. Overbought, oversold is for changes in trend,
so
not for trend continuation.
Where are we going with this? I mean, what sort of levels are we going with this, Daryl? Because, we've got not only the fundamental and the tech guys disagreeing, but the tech guys are disagreeing with other tech guys.
We're heading towards 2,000. That's where our upside target is. We are at the upper edge of that trading band at the moment. We can get a retreat back to the lower edge of that trading band, which brings us back to around 1,850. That's a reasonable sort of retreat. That's a buy opportunity for a continuation of this uptrend. The key factor, there are no end-of-trend signals within the charts.
It's going to keep on going.
Just keep on going.
Northbound.
Sit back and enjoy.
Northbound is what you're saying.
Right.
But, John, back to you. You're talking about this whole balance sheet issue with the Fed. It's only when they start shrinking that it's going to have, a material impact. The question is the sequencing. Yep. You've had some officials starting to talk about, look, we need to have that first rate hike first, and then we start shrinking. Or in other words, we stop reinvesting after bond assets mature. Has the market priced in that possibility, that we could get a rate hike first and then stopping of reinvestment?
I think they've not priced in the reinvestment story at all. In fact, I think the Fed's dialogue has polluted the language of talking about monetary policy. The Fed has an enormous amount on its balance sheet today. They got that by buying bonds and printing bank reserves. I'm so old, I remember when that was called printing money. When they reduce bank reserves, that's exactly the same as an anti-QE measure or selling bonds, and that's shrinking reserves. I don't believe they're going to have the courage to shrink reserves, which means that too many of these reserves will remain in place. And the big story in the U.S. is that there are two different banking systems working. The large banks are turning those reserves into loans for hedge funds, private equity firms, and M&A transactions. The small banks that once would have turned reserves into loans for small businesses have died because of regulations. There are 48% fewer banks today than there were in 2007. That means no small business loans, no jobs, and a slow recovery. So you get low rates, but at the same time, you get very, very vibrant financial markets.